This is a copper pipe, the kind that runs behind the walls of your house, carrying water from the main line to your faucets. It weighs about 2 pounds. At yesterday's spot price, the copper in this pipe was worth $11.40. This morning, that same copper is worth $14.80. Not because the pipe changed, not because demand shifted overnight. Because at 3:15 a.m. Eastern, the Federal Reserve authorized an emergency $5 billion liquidity injection into commodity clearing systems to prevent the largest copper short squeeze in market history from collapsing the financial institutions on the wrong side of the trade. The Fed doesn't intervene in commodity markets. That's not their mandate. Their mandate is monetary policy, bank supervision, financial stability. Copper prices are supposed to be someone else's problem. The CFTC, the exchanges, the traders who made bad bets. But at 3:15 this morning, copper became a financial stability problem. Because the traders who made bad bets aren't hedge funds that can be allowed to fail. They're the primary dealer banks that the entire financial system depends on. And their copper short positions just went from underwater to existential. This is not about copper getting expensive. This is about what happens when a physical shortage collides with levered financial positions, and why the Federal Reserve just used tools designed for banking crises to bail out commodity speculators. Here's what they're not telling you. The copper squeeze didn't start this morning. It started 6 months ago, when the gap between paper copper and physical copper began widening in ways that sophisticated traders chose to ignore. Paper copper is a futures contract, a promise to deliver metal at a future date. It trades on the COMEX exchange in New York and the London Metal Exchange in London. The price you see quoted, $4.85 per pound, $5.20 per pound, whatever the screen shows, is the paper price. It's what traders are willing to pay for promises. Physical copper is metal, actual atoms arranged in a crystalline structure. It sits in warehouses, travels on trucks, gets fabricated into wire and pipes and circuit boards. When a manufacturer needs copper to build an electric vehicle motor, they don't need a futures contract. They need pounds of copper they can hold, shape, and install. For decades, these two prices tracked each other almost perfectly. If physical copper traded above futures, arbitrageurs would buy futures, take delivery, and sell the physical at a profit. If futures traded above physical, arbitrageurs would buy physical, store it, and sell futures against it. The spread stayed tight because any gap created profit opportunities that traders rushed to close. That mechanism broke in August 2025. On August 14th, the London Metal Exchange reported that registered copper inventory had fallen below 15,000 metric tons, the lowest level since 1974. Not low by recent standards, the lowest in 50 years. At current consumption rates, 15,000 tons represents less than 2 days of global demand. The inventory decline wasn't a surprise. It had been falling for 18 months as electric vehicle production, renewable energy build-out, and AI data center construction consumed copper faster than mines could produce it. What surprised traders was the acceleration. In July alone, LME warehouses lost 8,000 tons, a rate that, if continued, would exhaust remaining inventory by October. Smart money saw the squeeze coming. They bought futures, took delivery, and moved copper off exchange into private warehouses where it wouldn't show up in official statistics. Every ton removed tightened the visible supply further. Every tightening encouraged more removal. The reflexive cycle that always precedes commodity squeezes was operating in plain sight. But other money, big money, institutional money, money that was supposed to be smart, made a different bet. They looked at the macro picture. They saw a slowing global economy. They saw Chinese property developers in crisis. They saw manufacturing PMIs below 50 in Europe and America. They concluded that demand would fall, prices would follow, and copper's elevated levels were a selling opportunity. So they sold, massively, without understanding what they were selling into. This is where the lie becomes unsustainable. To understand what happened at 3:15 this morning, you need to understand who was short copper and how badly their positions have turned against them. The Commodity Futures Trading Commission publishes weekly data on market positioning. The most recent report, dated January 14th, showed that managed money, hedge funds, and commodity trading advisors held net long positions in copper. They were betting on higher prices. That's the number financial media reported. But there's another category, swap dealers. These are the banks that provide commodity exposure to clients through structured products, ETFs, and over-the-counter derivatives. When a pension fund wants copper exposure without the complexity of futures trading, they buy a swap from a bank. The bank then hedges that swap by trading in the futures market. At least that's how it's supposed to work. The January 14th CFTC report showed swap dealers holding short positions equivalent to 847,000 metric tons of copper. 847,000 tons, roughly 5 months of global production, 56 times the entire LME registered inventory. These aren't speculative shorts, they're supposedly hedges against client positions. But here's the problem. When prices move against short hedges, the losses are real, even if the positions are hedged on paper. The bank owes money on the futures contracts regardless of what's happening in their swap book. And when inventory vanishes and physical buyers refuse to sell, the banks can't buy copper to close their shorts at any price the market quotes. They're short 847,000 tons. There are 15,000 tons available. The math doesn't work. At 11:47 p.m. Eastern last night, the LME published an emergency notice that copper prices had exceeded the exchange's daily price limit by 23%. Under normal rules, this would trigger a trading halt and a forced settlement at the limit price. But copper isn't normal right now. A forced settlement would require short sellers to either deliver copper they don't have or buy it at prices that would bankrupt. The LME chose a different path. They suspended price limits entirely, allowing copper to trade at whatever price the market would bear. And the market's price was $6.80 per pound, 43% above Friday's close. The swap dealer's losses, calculated on 847,000 tons of short exposure at a $1.95 per pound price move, exceed $36 billion. $36 billion in losses, concentrated in a handful of institutions that also happen to be primary dealers of U.S. Treasury securities, counterparties to trillions in derivative contracts, and nodes that the global financial system cannot function without. When those institutions fail, the system fails. The Fed understood this at 3:15 a.m. When the Federal Reserve intervenes in commodity markets, something has broken that supervision couldn't prevent. The $5 billion emergency injection wasn't a bailout of copper positions. It was a liquidity backstop for clearing systems that were about to freeze. Here's how commodity clearing works. When a bank has a losing futures position, they must post margin, cash or securities, to the clearinghouse that guarantees the trade. As losses grow, margin calls increase. If a bank can't meet a margin call, the clearinghouse closes their position by buying in the open market and seizing whatever margin was posted. But what happens when the open market has no sellers? When the copper physically doesn't exist at any price the exchange can transact? The clearinghouse can't close the position. The margin they've seized doesn't cover the loss. And the clearinghouse itself becomes insolvent because it guaranteed a trade that cannot be settled. CME Group, which owns COMEX, is the largest derivatives clearinghouse on Earth. If CME's copper clearing fails, confidence in all CME clearing fails. If CME clearing fails, every futures market CME operates, Treasury bonds, S&P 500 futures, currency derivatives, become suspect. The contagion from copper to the entire financial system takes hours, not days. The Fed's $5 billion injection went directly to CME's clearing fund. It's a firewall, a guarantee that even if copper positions can't be settled in copper, they can be settled in dollars at whatever price stops the cascade. The losses will be socialized, spread across the financial system through mechanisms that haven't been fully disclosed, but the system will survive. The traders who are short won't survive. Their institutions might. They won't. Less than 72 hours remain before the next wave of LME copper contracts expires on Thursday. Open interest in the January contract is 234,000 tons. Deliverable inventory is 15,000 tons. Even with the Fed's intervention, even with price limits suspended, the fundamental problem remains. More copper has been promised than exists. The January contracts will settle in cash at prices that haven't been determined. February contracts face the same math. March, the same. Until physical supply returns to exchange warehouses, which could take months as miners ramp production and consumers reduce demand, every copper contract is a game of musical chairs with not enough seats. While one side scrambles, the other side delivers. China's role in this squeeze illuminates everything about how physical commodity markets actually function. For 18 months, Chinese copper imports have exceeded domestic consumption by an estimated 400,000 tons. The excess hasn't appeared in visible inventory. It hasn't been re-exported. It's vanished into strategic reserves that Beijing neither confirms nor denies. China watched Western financial institutions build short positions while China accumulated physical metal. They watched paper traders bet against a commodity that China's industrial policy requires in unlimited quantities. They watched, and they bought, and they removed every ton from the deliverable float that Western shorts needed to cover. This isn't manipulation. China has every right to buy copper for their own industrial needs. But the effect is identical to manipulation. The supply that short sellers assumed would be available when they needed to cover simply isn't there. It's in Chinese warehouses, backing Chinese manufacturing, supporting Chinese supply chains. It's not coming back to London or New York to bail out traders who bet wrong. At 6:30 a.m. Beijing time this morning, China's State Reserve Bureau issued a one-sentence statement. Strategic commodity reserves are adequate for national development needs. Translation: we have the copper, you don't, and we're not selling. The squeeze isn't over, it's just beginning. Some will look at this morning's Fed intervention and see a system working. We'll trust that $5 billion is enough. We'll assume that cash settlement replaces physical settlement without consequences. We'll believe that copper prices will normalize once speculative excess is wrung out of the market. These are the same voices that said subprime mortgages were contained, that said long-term capital management was an isolated incident, that said Lehman Brothers could be allowed to fail without systemic consequences. The voices are always confident that bailouts work until they discover the losses that bailouts defer. Others will recognize what 3:15 a.m. actually means. That the Federal Reserve, an institution with no mandate over commodity markets, was forced to intervene because commodity positions threatened financial stability. That 847,000 tons of short exposure against 15,000 tons of inventory was a bomb that everyone could see, but no one diffused. That the bailout preserves institutions while validating the trade that broke them. The informed are not predicting $10 copper or financial collapse or any specific outcome. Predictions require certainty that doesn't exist when central banks are improvising solutions to problems their frameworks don't address. What the informed recognize is that the copper market has demonstrated something that applies far beyond copper. That paper claims on physical commodities can exceed physical supply by 50 to 1. That the banks making markets in those claims can be catastrophically exposed. That when the mismatch is revealed, the Fed will bail out the banks rather than let the system discover what real prices should be. This is not financial advice. This is not a recommendation to buy copper or short banks or take any position based on this morning's intervention. This is simply an observation about what happens when a physical shortage meets leveraged financial positions, and who pays when the math stops working. The copper pipe in your wall hasn't changed. The water still flows. The atoms are still arranged in the same crystalline structure. But the price of those atoms, and who controls them, and what the Federal Reserve will do to prevent that control from collapsing the financial system, changed permanently at 3:15 this morning. 15,000 tons of inventory, 847,000 tons of short positions, $5 billion of emergency liquidity. The numbers tell you everything about what broke and nothing about whether it's actually fixed. The shorts are still short, the copper is still missing, and the Fed just showed you what they'll do when physical reality and paper promises can no longer coexist. They'll print. They'll always print. The only question is what the copper, the actual physical copper, will be worth when they're done.